Every bull market creates philosophers. The stock goes up and suddenly everyone has a deep theory about innovation, liquidity, demographics, and destiny. The stock goes down and the same theory quietly becomes, I was always long-term. Graham's chapter 8 is the cure for this. He separates two very different activities, timing and pricing. Timing means trying to forecast the market's next move. Pricing means asking whether the price offered is attractive compared with value. Graham is deeply skeptical that the ordinary investor can win by forecasting the market. But he absolutely wants the investor to care about price. This is an educational book summary episode from The Intelligent Investor by Benjamin Graham. Today we are using Mr. Market to understand why price movement is information, not instruction. This is where Mr. Market enters. Imagine you own a private business with a partner who appears every day offering to buy your share or sell you his. Some days he is euphoric and offers a foolishly high price. Some days he is miserable and offers a foolishly low price. You are not required to agree with him. You are not required to feel what he feels. You can use his quote, ignore his quote, or wait. That is the whole magic of the metaphor. Mr. Market is useful only when you remember that he works for you. His job is to provide quotations. Your job is to judge them. The framework for this episode is a 3-question market fluctuation test. Question 1. Did the business value change, or did only the quote change? A falling price can mean the business is weaker, but it can also mean fear is louder. You need evidence, not just a red number. Question 2. Does the new price improve or reduce the margin of safety? Lower prices can improve future prospects if value remains intact. Higher prices can reduce safety even while everyone feels smarter. Question 3. Am I reacting to a plan or to a feeling? If the decision would look embarrassing in a written journal tomorrow morning, the decision probably needs a pause. Jason Zweig's commentary gives modern examples from the technology bubble. Companies with exciting stories were priced as if the future had already arrived perfectly. Then mood changed. In many cases, the business story had not changed enough to justify the violent swing. Mr. Market had simply moved from euphoria to despair. The Indian investor can recognize the same pattern in any market cycle. A sector becomes fashionable, valuations stretch, ordinary business risks are ignored, and price movement starts being treated as proof. Then conditions change, and the same crowd discovers balance sheets, cash flow, and patience at exactly the wrong time. This is illustrative analysis only. It is not a recommendation about any sector or security. The lesson is behavioral. Price movement is information, but it is not instruction. The checklist item: before acting on a sharp price move, write 2 sentences. Sentence 1. What changed in the business? Sentence 2. What changed only in the market's mood? If you cannot separate those, do nothing until you can. In the next episode, we go inside the numbers. Graham warns that even earnings per share can mislead when investors read the headline and skip the footnotes. Thanks for listening. If this episode helped you treat market prices as offers instead of commands, that is the real goal. Until then, take a proper walk without turning it into a productivity challenge. You are allowed to move your legs with no spreadsheet outcome. Radical concept, but promising.